Appraisal gaps explained, the hidden risk in competitive offers. If you're searching for a home in Northern Virginia, you've likely heard terms like offering above asking price, waiving contingencies, or including appraisal gap coverage. In a fast-paced market like Fairfax or Loudoun County, these phrases may seem standard. However, one significant financial risk is the appraisal gap. Today, we'll break down appraisal gaps in simple terms, why they occur, how they impact both buyers and sellers, and how understanding them can save you thousands of dollars and reduce stress. Let's start with the basics. When a buyer purchases a home with financing, the lender usually requires an appraisal before approving the loan. This is a critical step in the mortgage process. The appraisal's purpose is to provide an independent opinion of the property's market value, not to determine if the buyer loves the home or if the seller deserves the asking price. Why is this important? The home serves as collateral for the loan. If the lender needs to recover the balance, they want assurance that the property's value supports the borrowed amount. This is where appraisal gaps come into play. Imagine a home in a competitive Fairfax neighborhood has an asking price of $775,000. One buyer offers $800,000. When the appraisal comes back at $775,000, there's a $25,000 difference. That precisely is the appraisal gap you need to manage. Many buyers mistakenly believe this means the seller must lower the price or that the lender will finance the higher amount. Neither assumption is guaranteed in a Northern Virginia contract. What happens next depends on various factors, including contract language, buyer financing, available cash, appraisal contingencies, and the negotiation willingness of both parties involved. So, why might an appraisal come in lower than expected? Appraisers measure market-supported value, not excitement. Excitement often drives prices up faster than the data can follow. If two identical homes sell for $770,000 and another sells for $800,000 due to high competition, the appraiser may not have enough evidence to support the higher price yet. Additionally, limited comparable sales can lead to lower appraisals. If a home has unique features or renovations that nearby properties lack, it may be challenging to assign value based on recent sales. This highlights the importance of understanding local market conditions. Different areas and even different streets can behave differently, affecting how an appraiser views the data. An appraisal is designed to estimate market value using objective information. Sometimes it matches the purchase price, sometimes it's higher, and sometimes it's lower. You must prepare for all three. When a low appraisal occurs, many buyers assume the transaction is doomed. Fortunately, it often becomes a negotiation point. It's not the end, it's the start of a new conversation. Buyers can choose to bring additional cash to closing, request the seller to lower the price, or find a compromise. Each path has its own financial implications you need to consider. Another option is to request a reconsideration of value. This is a formal process that allows the lender to review additional evidence that might have been missed in the initial report. To do this, your agent provides the appraiser with more recent comparable sales or points out upgrades that weren't fully accounted for. It's a standard tool in a competitive real estate market. One key concept in this discussion is the loan-to-value ratio, or LTV. Lenders typically base financing on the lower of the purchase price or the appraised value. This is a hard rule. If you plan to buy for $800,000 with 20% down, but the appraisal hits $775,000, the lender uses that lower amount to calculate your loan. This means you, as the buyer, must contribute more cash to maintain your desired loan terms. It essentially shifts part of your financing into a cash requirement at the closing table. This is why it's essential to discuss appraisal scenarios with your lender before making offers. Knowing how different appraisal outcomes affect your monthly payment and cash is vital. Appraisal gap coverage has become common in competitive markets. This means a buyer agrees to contribute additional cash if the appraisal falls below the contract price up to a certain amount. For example, if buyer A has no gap coverage and buyer B offers to cover up to $25,000, buyer B's offer may be significantly more attractive to the seller in Loudoun County. However, buyers should only include appraisal gap coverage if they fully understand their financial position. Committing to cover a gap without known funds can lead to legal issues. From the seller's perspective, the highest purchase price isn't the only factor to consider. You have to look at the certainty of that price actually reaching the finish line. Evaluating the entire offer, including financing strength and appraisal terms, is crucial. A slightly lower offer with strong financing and cash reserves may be more reliable for a seller. Reliability often beats a higher number that might fall apart during the appraisal process. Sellers in Northern Virginia are increasingly prioritizing certainty over the absolute highest paper price. To avoid costly mistakes, buyers should remember that winning the offer is just one milestone. There are still financing deadlines, inspections, and appraisals to navigate before closing day. Winning is just the beginning. The goal is a successful closing. Common mistakes include assuming lenders will finance whatever you bid and offering gap coverage without the funds. Sellers should also avoid evaluating offers solely based on price. Organizing information about recent home improvements can help appraisers understand the property's true condition better. Strategic preparation is key for both sides. When everyone understands the risks and has a plan for the appraisal gap, the entire transaction becomes much smoother and less stressful. In conclusion, real estate decisions are rarely determined by a single number. Successful transactions happen when buyers prepare and sellers look beyond the top-line price. An appraisal gap should be viewed as a planning exercise. The most successful participants in this market are those who navigate these gaps with confidence and informed strategy. If you're planning to buy or sell a home in Northern Virginia, remember that every property and transaction is unique. Local conditions and scenario planning make the difference. The goal isn't just to get under contract, it's to reach the closing table with confidence, knowing you've made informed decisions every step of the way. You deserve that peace of mind. When inventory is low, competition naturally pushes prices above recent sales data. In Northern Virginia, this isn't just a trend. It's a persistent reality that requires a tactical approach. Strategic bidding means knowing exactly how much cash you have available to cover a potential gap before you even step inside the home. It's about setting your limits early. Think of your appraisal gap coverage as a safety net. It allows you to stay competitive without over-leveraging your future financial stability. It protects both your offer and your bank account. If a gap occurs, don't panic. Negotiation is still possible. Your agent can work with the seller's agent to find a middle ground that keeps the deal moving forward toward closing day. By working together, buyers and sellers can find solutions that satisfy both parties' needs. Closing the deal is the shared objective, and a clear gap strategy is the map to get there. At DCI Homes, we believe in empowering you with the knowledge to make those choices count. We are dedicated to helping you reach your real estate goals with absolute confidence. If you enjoy our content, please like and subscribe to support the channel. It really helps us keep creating high-quality videos. Thank you for watching, and we'll see you next time.